You've probably already heard some people in the market sharing the same thing, saying, hey, you know not, market crashing. Buy the dip because the S&P 500 is on sale. And honestly, they're not wrong that this could be a buying opportunity. But here's the thing nobody's talking about. How you buy the dip matters just as much as whether you buy it. Because if you go all in right now, you could potentially be walking into a trap. So stick with me because by the end of this video, I'm going to share with you what I plan to do, what I personally am doing with my money right now, and it's definitely not sitting on the sidelines. So let's start with where we currently are at. So the S&P 500 is down over 5% year to date, and that's before factoring into last week's fresh volatility from the Iran war and oil prices surging past $100 a barrel a few days ago. So now a lot of people are pointing to last year as proof that buying the dip always works. And fair enough, the S&P 500 fell nearly 20% in 7 weeks around last April's Liberation Day tariff announcement. Then it rebounded more than 30% from its low. So people who bought in certainly did very well. But here's the question I keep asking myself. Is this the same situation? And when I look at 5 specific signals right now, my answer is not quite. So let me show you what I mean. Okay, let's look at signal number 1. Okay, the first signal is that the market is still really very expensive. Valuation is still dangerously high. So there's this measure that they use in the finance world and it's called the CAPE ratio. Think of it as a price tag for the entire stock market. When it's high, you're overpaying. And when the CAPE ratio is low, you're getting a deal. So a CAPE ratio above 25 to 30 is generally considered high. And do you know that the S&P 500 CAPE ratio actually hit above 40 in January? So that's like the most expensive reading since the dot-com crash. And historically, that level has correlated with a 30% decline over the following 3 years. So yes, prices have certainly come down a little, but we're not at bargaining territory yet. This is less like a 70% off sale and discount and more like something that was $200 and then suddenly marked down to $180. It is still overpriced, but I'm not asking you not to go and buy it. What I mean is don't go all in thinking you're getting a steal, a lobang. Remember, a dip is only a bargain if the thing was fairly priced to begin with. If you're buying an overpriced item on sale, it is still overpriced. So let's look at signal number 2. I just want to highlight that tariffs aren't just a political headline. They are really hitting company profits directly. So here's something that was promised when tariffs were first announced. Remember, they said that foreign countries would have to pay them. But multiple independent studies already tell a different story. For instance, Goldman actually found that US companies and consumers collectively paid over 80% of tariffs, and by mid-2026, 67% of the burden is expected to fall on consumers alone. What does that mean for stocks? Okay, it means that lower consumer spending is expected, which will result in lower company revenues, which means lower earnings and then lower stock prices. It's a chain reaction that plays over months, not just days. Furthermore, the Congressional Budget Office confirmed that tariffs will result in real GDP being lower than it would have been without them. And we are already seeing it. Let's take a look at Nike. The stock actually hit a 9-year low last week because partly tariffs are squeezing the margins. That's a real world example happening right now. So my point is, if the company earnings are about to disappoint, the dip could get deeper before it gets better. So timing kind of matters. And now let's look at signal number 3. And this is the one that really definitely concerns me. Guys, we're not dealing with one problem. We are dealing with several headwinds coming all at once. Right now, the market is being weighed down by the war in Iran, elevated oil prices with $100, more than $100 a barrel. And there's serious questions about how strong the US economy really is, the world economy. So oil above $100 a barrel means higher prices for everything. You know it. Transportation, manufacturing, groceries. This is going to hit consumer spending really hard soon. On top of that, 2026 is a midterm election year. Historically, the S&P 500 has fallen into correction territory in 12 out of 7 midterm elections since 1957. Guys, that's a 70% hit rate. So last year, people bought the dip and they think it works. But there was one problem, tariff fear. That fear faded and a deal was made, markets recovered. Right now, it's different. We have tariff, the war, high oil, stretched valuation, and a midterm election year. I think it's a very different cocktail and it's something we definitely should be very, very cautious about. The fourth signal. This is a technical one that technical analysts watch like a hawk and right now is flashing a warning sign. There's something called the 200-day moving average. Here's all you need to know about it. Imagine you take the S&P 500 price every day for the last 200 days and then you draw a smooth line through all of them, okay? That line actually tells you the market's long-term health. When the index is above that line, it's healthy, it's bullish. When it drops below it, that's a red flag. So as of 1st April, the S&P 500 was like trading at 6,000 plus, sitting just below its 200-day moving average at 6641. That means the market has lost its long-term momentum and technically in bearish territory. And it gets worse when you dig and look underneath the surface. Actually, only 27.6% of stocks in the S&P 500 are trading above their own 50-day moving average, meaning the vast majority of individual stocks are already in short-term downtrends. So here's the important part. When the S&P 500 breaks below the 200-day, history shows that level often acts as resistance on the way back up. So even if the market kind of like bounces, it could hit that line and fall again. That's not just a buy signal, that's kind of like a trapdoor. And a caution, a signal to tell you to proceed with caution if you want to enter the markets. So, I mean, the 200-day moving average isn't a crystal ball, but when it aligns with everything else we've talked about, the thing about overvaluation, tariffs, geopolitical risks, it kind of adds one more reason to pause before you hit the buy button, right? And the fifth signal I'm watching is the VIX, which is Wall Street's fear gauge. The VIX measures how much volatility the market expects over the next 30 days. So think of it like a weather forecast for turbulence. So a low VIX means like seas are calm, everything is okay. But a high VIX, everyone's worried, right? They will go and buy or chiong for the life jacket. So on average, the VIX actually sits around 20. So below 20 means calm seas, but above 40, the magic number, it means extreme fear. And interestingly, extreme fear has historically been one of the best buying signals. So after major VIX spikes above 40, the S&P 500 has delivered positive returns about 70% of the time within a year. So right now, the VIX isn't that high. It's around 23 to 25, elevated but not at peak panic levels yet. But I would like to highlight that actually earlier in 2026, it actually touched above 30 before it came back down. So that kind of like signals to me that fear is present, but it hasn't peaked yet. The market hasn't quite fully priced in all of this bad news that we've talked about. So what I'm personally looking out for is whether the VIX spikes above 35 or 40. And when it does, it starts to fall. That's the signal that fear may be peaking and a real recovery could be beginning. So that's when I'll be considering whether I want to accelerate my buying or not. But today, I don't think we are there fully yet. Okay, so I've kind of like given you my 5 reasons or signals why going all in right now is risky. But here's what I really want to be clear about. I'm not telling you to go and like, wow, panic sell everything and then hide all your money under your blanket or your mattress or your bed. That's not the point of this video, because here's the truth, okay, guys. Nobody, not me, not any analyst on Wall Street or the smartest person is going to know exactly when the bottom is. And it's like waiting for the perfect moment is almost impossible, and it often means missing the recovery entirely. So the question is not whether you should buy the dip. The question is, how should you buy the dip? And that's when strategy matters. So I'm going to share with you my game plan, whether you agree or not. This is just my personal opinions. So today I'm already like invested in long-term ETFs, and I will continue to stay invested. I'm not going to like panic sell or do anything, right? Because to me, actually, the time in the market beats trying to consistently time the market. So we always have new monies from the salary that we earn, right? So for those new monies that I'm looking to deploy, dollar cost averaging is going to be my strategy. Whether it's ETFs or other investments, instead of placing everything in a large amount all at once, I'm going to put it in a fixed amount every single month, regardless of what the market does, right? When market prices fall, my fixed amount will buy more shares of the ETF automatically. And when price rises, I'm still going to be in and benefiting. So to me, it kind of like removes all this pressure of trying to time the bottom perfectly, because like I said many times, nobody can do that perfectly and consistently. And before I do all of this, I'm definitely going to keep a cash buffer of at least 6 to 9 months of expenses before I invest a single extra dollar. This is definitely non-negotiable for me, because if the market drops another 15% and I need money, right, I don't want to be in a position where I'm forced to sell everything at the loss, because to me, cash buffer is what gives us the freedom to stay invested through volatility without panicking. And lastly, I'm going to watch the VIX, and I have a plan to increase my contribution if it spikes. So remember what I said earlier, if the VIX is above 40 and that starts falling, it's historically been proven as one of the strongest buying signals. So to summarize all of what I just said in this video, yes, I think the situation is real, the dip and the fall is real, it's scary, and I don't think it's going to be over yet. But I also feel that sitting on the sidelines, waiting for that perfect moment to buy the dip isn't the right answer either. So to me, dollar average in, protect my cash buffer, and I'm going to watch the VIX for signal to lean in harder. So that's the strategy I would be running right now. So I'm not sure if you guys agree with me. How about you all? Are you buying the dip right now, and how are you guys doing it? In the meantime, you found all of this that I'm talking about useful. Do follow me on that financial goal for more of this, and I hope to see you guys in the next. Do remember to like, share, and subscribe. Kamsia you.